As an ex-banker with 36 years of experience in banking and financial consultancy, and who has seen most of the market crashes in the last 50 years, I would like to know from you, what is the single biggest mistake destroying your mutual fund returns? Please write in the comments. Well, I'll give you a clue. It's not which fund you choose or the fees that you're paying. As you all know, crude oil price is skyrocketing. The global markets are crashing and rupee has hit 96 against the dollar. Is the money in your bank safe due to inflation, or is SIP a better bet? If you're trying to navigate these chaotic market conditions alone, well, you're in trouble. You will withdraw your SIP at the earliest. You need an advisor who can tell you about the historical data. Let's take the example of the US-Iran war. Well, when the war started, for almost 3 months, the markets were in the negative. There was a truce, the markets recovered. Well, the war restarted and now the markets are volatile. Well, how do one person protect their capital? They stay invested for the long term. Mutual funds do not give you positive returns in the first 5 years. Well, according to historical data, in the first year they gave you a negative return of around 38%. Third year, they give you a negative return of 19%, and fifth year, around 12% negative returns. Well, the pain point is not the market, it's your behavior. Let's take an example. You're buying physical gold. The market crashes. Do you sell it? Not at all. But take the case of a gold ETF. What happens when the market crashes? You panic and you hit the sell button. The moment the news turns bad by reacting to the noise, you are not protecting your money. You are actively guaranteeing a permanent loss of capital to inflation. Well, here is a 3-step solution for you to see that the market uncertainty does not affect you. Step number 1, look for long-term investment. Look to invest for the long term. Well, long-term returns have never been negative according to historical data. Time completely sanitizes your risk. Step 2. Build a core satellite portfolio. Have a look at the returns of the past 3 years or the past 3 years. Well, as you know, PwC has given a report that only 23% of them will continue after the 5 years. So, build a core portfolio that includes India's structural growth sectors such as healthcare, manufacturing, defense, infrastructure, banks and NBFCs. And I would suggest the multi-cap strategy for you to capture the upside in the long term. Step number 3, define the exit rules. There are only 2 reasons for you to exit the market. 1, you do not have fund to fund your SIP. Or 2, you have achieved the goal. The goal can be your child education fund being created or the renovation of your house corpus being achieved. Well, when you stop your SIP, you're throwing away your superpower. What's the superpower? Well, that is rupee cost averaging. Think of it this way. A market downturn is a sale of high quality investments. You should be buying more, not walking away. Well, the secret to building wealth is in timing the market. It is time in the market. Well, we help you to calculate your potential SIP returns based on your current investments. Or do you need help in reviewing your current mutual fund portfolio? Well, you'll find the link in the description below. You can book a free 1-to-1 call, link in the description. This video is made for educational purpose only. Disclaimer in the description. Please like and subscribe to my video. Thank you.